$400 a month. Or $30 a month. Same $500,000 death benefit. Same healthy 30-year-old. One of these is term life insurance. The other is whole life. And the difference between them is one of the most expensive mistakes in personal finance. In this video I'll show you exactly how each product works, what your agent gets paid to sell you each one, the 20-year side-by-side math, and the small group of people whole life actually makes sense for. No sales pitch. Just math. Let's start. Term life insurance is simple. You pay a small premium. If you die during the term, say 20 years, your family gets $500,000. If you outlive the term, the policy ends. It's pure protection. Like car insurance for your life. There's no savings account, no investment, no cash value. That's why it's cheap. Whole life insurance bundles two things together, a death benefit, and a savings component called cash value. Part of your $400 premium pays for the insurance. Part goes into the cash value, which grows slowly at a rate the insurer sets. And part goes to fees and commissions. Here's the key. Because whole life lasts your entire life and builds cash value, it costs 10 to 15 times more than term for the same death benefit. Same $500,000 payout. 13 times the price. The insurance industry sells whole life as protection plus savings. But when you separate the two and price them honestly, you're paying an enormous premium for a savings account with a very low return. Now let's talk about why your agent recommends whole life so strongly. It's not a mystery. It's the commission. On a whole life policy, the agent typically earns 50 to 100%, sometimes more, of your entire first year's premium. On a $4,800 a year policy, that's $2,400 to $4,800. To the agent. In year one? On a term policy, the commission is a fraction of that. So when an agent sits across from you, they have a choice. Sell you the product that pays them a few $100s, or the product that pays them a few thousand. The incentive is enormous, and it's not aligned with yours. This is why you'll hear whole life described with words like permanent, guaranteed cash value, forced savings, and be your own bank. These are marketing frames built to justify a product that pays the seller far more than it pays you. The agent isn't necessarily a bad person. But the compensation structure rewards selling you the expensive product. You need to know that before you sign anything. Let's run the actual numbers. Same person. Same $500,000 death benefit. 20 years. Option 1 whole life. You pay $400 a month. Over 20 years that's $96,000 in premiums. At the end, your cash value is roughly $70,000 to $90,000. If you die, your family gets $500,000. If you cancel, you get the cash value, minus surrender charges if you leave early. Option 2, buy term and invest the difference. You pay $30 a month for the same $500,000 term policy. That leaves $370 a month. You invest that $370 in a low-cost total market index fund at an average 8% return. After 20 years, that investment grows to about $218,000. The whole life cash value? About $80,000. Same $370 a month. One approach leaves you with $218,000. The other leaves you with $80,000. That's a $138,000 difference, for the exact same death benefit. And it gets worse for whole life. With term, if you die, your family gets the $500,000 and you've been building a separate investment account. With whole life, the insurer typically pays the death benefit and keeps the cash value. Your family doesn't get both. In most whole life policies, the cash value does not get paid out on death. The insurance company keeps it. So you're paying 13 times more for a savings account that grows slowly, that your family usually doesn't even receive if you die. 3 more things the sales pitch leaves out. 1. Surrender charges. If you cancel a whole life policy in the first 10 to 15 years, you forfeit a large share of your cash value. Many people who realize the mistake early still lose thousands getting out. 2. The cash value grows very slowly at first. Because fees and commissions are front-loaded, your cash value in year 5 is often less than the total premiums you've paid. You're underwater for years. 3. The guaranteed return on cash value is low, often in the range of 2 to 4%, and the illustrated projections agents show you are frequently optimistic. Meanwhile, the market's long-term average is closer to 8 to 10%. You're locking your savings into a low-return product while paying a massive premium for the privilege. This is why buy term and invest the difference wins for the large majority of people who just need to protect their family's income. To be fair, whole life isn't a scam for everyone. It makes sense for a small group, maybe 2% of buyers. If you have a very large estate and need liquidity to pay estate taxes without forcing your heirs to sell assets, permanent insurance can help. If you're funding a special needs trust for a dependent who will need care for their entire life, a permanent policy fits. If you're structuring certain business succession or key person arrangements, it has a role. The common thread: these are people with a permanent need that genuinely never expires, and often with estate or tax complexity. That is not most people. Most people need to replace their income while their kids are young and their mortgage is outstanding. That need ends. Term matches it exactly, for a tenth of the price. If an agent is pitching whole life to you as an investment or a retirement vehicle, and you don't have a multi-million-dollar estate or a special needs dependent, that's a red flag. Here's the action list. 5 steps. 1. If you need income replacement, get quotes for level term life insurance. 20 or 30-year term, 10 to 12 times your annual income in coverage. 2. Compare at least 3 insurers. Term is a commodity. Price shop it. 3. Take the money you save versus a whole life quote and invest it in a low-cost total market index fund. Automate it. 4. If you already have whole life, don't cancel it tomorrow. First, get a term policy in force so you're never uninsured. Then check your surrender value and decide whether keeping or surrendering the whole life policy makes sense. If you're within the first few years, the math usually favors getting out. If you've held it for decades, it can be closer. 5. Only consider permanent insurance if you have a genuinely permanent need. Estate taxes, a special needs dependent, or a business structure. Otherwise, buy term and invest the difference. The short version of this is pinned on the channel. Follow for one money rule a day. No hype. Just math.